Federal Reserve has decided to hold off on an interest rate hike after a two-day meeting on the matter, but projected two more hikes for later this year, which could raise interest rates as high as 5.6% before the end of 2023, according to CNBC. If the Federal Reserve had decided to hike up interest rates this week, that would have been its 11th consecutive interest rate increase.
CNBC reports Fed Chair Jerome Powell said yesterday, following the decision, "We have raised our policy interest rate by 5 percentage points, and we've continued to reduce our security holdings at a brisk pace. We've covered a lot of ground, and the full effects of our tightening have yet to be felt." The next meeting for the Fed is set for July 25th to the 26th. Meanwhile, earlier this week, Treasury Secretary Janet Yellen was questioned on sanctions and threats to the dollar supremacy when testifying before the House Financial Services Committee. Let's hear some of what she had to say.
It is true that when we impose sanctions, countries that are afraid they can be the subject of those sanctions are motivated to look for other tools other than the dollar to engage in transactions.
So I think what I'm getting at from what she says there is basically, if we impose sanctions, people will find alternatives to the dollar, alternatives they might stick with. And if we impose sanctions on countries, for example, like Russia, there's a really funny story about Stephen Kinzer, who was a foreign correspondent for many years, now writes about American intervention. He went to Russia, and the waiter pointed out, "Look at what great cheese we have. This is Russian cheese. We used to import it from Europe, but then because of the sanctions, we learned how to make our own cheese. And now we have such great cheese." And it's really an example of how sanctions can make countries self-sufficient or at least independent from the United States in the global economy.
Yeah, exactly. And I mean, we've seen a similar move with Russia being able to still, financially support itself with its massive oil programs and oil sales, whereas the U.S. has moved away from energy independence, which has made it really affected by these price hikes in energy. So these sanctions always have these latent side effects that it seems like the people in power don't really consider. On the question of the interest rate hike, I don't think it's super surprising that they decided to hold off. It was, quite a few interest rate hikes in a row, and they wanted to kind of give it a pause to see what the effect of those is actually going to be on the economy. Obviously, things don't happen instantaneously in such a massive economy like ours. And we talked on this show about the last jobs report and about the fact that although it looked really good on the surface, we also learned that due to the household survey, a lot of individuals were actually taking on second or third jobs, and the unemployment rate rose at about the same level as the number of people taking on additional jobs or jobs created. And so that gave the Fed a good reason to hold off until its next meeting.
Yeah, it sounds to me that there was some pressure from Wall Street and folks involved in the banking community following the banking collapses we saw this past spring. And a lot of blame was directed towards interest rate hikes. Of course, all banks should be stress testing for conditions like the ones we're experiencing now, where there's an incredibly high interest rate after a period of low interest rates. They should have been prepared for that. I don't think that's a legitimate excuse for a lot of the losses that these banks experienced and needed to be bailed out by JP Morgan Chase and the Fed and what have you. I don't think that's an excuse or a reason, but I do think that there was a lot of pressure put on the Federal Reserve by Wall Street and by folks who are concerned about the sentiment around the collapse of banking in the United States, which we know really isn't the case. It was a few regional banks and was generally concentrated to those banks. But nevertheless, the sentiment was there, and the blame of the Fed was being made. These interest rate hikes have not been popular. And so it tracks that they would say this month we're going to keep it unchanged, but we still expect the economy to cool off as a result of getting these rate hikes up to 5%.
Yeah, I mean, selfishly, I don't obviously like the interest rate hikes because I just purchased a home. So, of course, I want to try to refinance as quickly as possible. So hearing the news that they're going to continue to push rates up over the next year, most likely, is definitely concerning. And I know a lot of Americans feel the same way that I do. When you're facing inflation coupled with the interest rate hikes. It's a really difficult economic situation for a lot of people. It means that a lot of people are priced out of home ownership because naturally you can afford much less house when interest rates are higher, when mortgage rates are higher. So it's a really tough time. A lot of Americans are tightening their belts, and it's sort of a 1-2 punch with what they were facing during the pandemic, with a lot of people being forced to stay home and not being able to work. And then you get out of the pandemic and all of a sudden everything is more expensive and your wages might be increasing. The job market is largely beneficial to employees more than employers right now, but they're certainly not keeping up with inflation. So this is, just a really dastardly situation for especially people who aren't as privileged as I am.
For a long time, it was kind of concentrated to the progressive camp of the political spectrum in the United States that this inflation was not demand driven. It was not a situation of too many dollars chasing too few goods. So reducing the money supply or the amount of dollars the average working person has, which is the Fed's approach, would not be an appropriate one. Now we're at a point where Bloomberg just ran a survey this past week, and they found that the majority of investors on Wall Street actually believe the price increases are caused by corporate greed, which becomes very transparent when you look at a balance sheet and you see that their input costs did not go up, but their prices did. They're not raising prices to compensate for inflation that stems from anywhere else other than them making the decision that we're going to raise prices and increase our profit margins and therefore returns to shareholders, which means that our chief executives who are making the decisions about price increases are going to get kickbacks and returns and bonuses because of the increasing stock value of the company. And so that exact feedback loop is hurting Americans all across the country, while chief executives and shareholders on Wall Street are getting rich off of this decision-making process. And you're squeezing workers because the Fed's policy and approach will still shrink small businesses. It will still make more people unemployed. It will still bring wages down without addressing the problem of price increases. And so I think it's an interesting change of tune that investors on Wall Street are recognizing this as well, but it's pretty clear in the numbers and the data.
Yeah, I think it's fair to say that quite a few businesses are definitely trying to make up for lost income during the pandemic by raising prices a bit higher than inflation alone would suggest they should be. At the same time, of course, our current inflation is caused by quite a few other things outside of corporate control, such as supply chain issues, the fact that people changed what they were spending money on during the pandemic. We kind of moved away from a services-oriented economy to more of a goods-based economy, which is relatively new for the past 5-10 years in the United States. We also had, of course, a couple of massive pieces of legislation passed that injected tons of money into the economy. So it's definitely not a single-pronged issue in terms of where this inflation is coming from.
Yeah, well, we did have some important economic stimulus that was necessary to get the economy going. We also saw the IRS have a record collection year as well. So money put into the economy and taken back out. And the output gap being negative year over year is the exact metric that would tell us if we do have too many dollars chasing too few goods, and it remaining negative is confirmation that that's not the case. And when it comes to supply chain issues, was a huge problem at the beginning of the pandemic, did cause a lot of inflation. But seeing now that we have record profits at companies like Kroger, grocery stores across America, the 5 biggest oil company raking in billions of dollars, when you have profit margins that are high, it suggests that if the inflation was caused by supply chain issues, they would have had to increase their spending when it came to input costs to get those goods and services to market or get those goods and services to the warehouse for production. And so we wouldn't see record profits if they were increasing prices proportionally to those additional costs they're incurring. So I think there were definitely drivers of inflation from the switch. Everybody went inside, they were staying at home, they weren't eating in restaurants, they were instead going out grocery shopping. That put a lot of pressure on the goods sector and the things people were buying during the pandemic. That was not there before, and that did cause some price increases. But I think now we're not seeing that as the cause of inflation anymore, and prices have remained high I think because these corporations are motivated to keep lining their pockets with the money. If people are still buying things, they're going to keep the prices high.
Yeah, and let me suggest to some of the companies out there that you could make a lot of money if you undercut your competition just a little bit and still bring in a profit, and that would be a win-win for everybody. We'll be back with more Rising after this.